So, in this video we're going to be talking about a strategy which was suggested by someone in the Discord group, and after a week of refining the strategy and refining the framework, backtesting it and analysing it, we now have a strategy we are working with over the coming weeks to take short-term positions in stocks and profit from volatility. As we have seen during this current earnings period, there have been a bunch of stocks which, having missed their earnings estimates, have dropped significantly in stock price. Wix down 27%, Shop down 18%, and RBLX down 27%, just being some examples among many, many more. This strategy is not for everyone though, as it is options based, and it's probably best used by the more experienced investors who understand options, have traded them before, and know the risks associated with them. It's not a new strategy either, but for some reason nobody is talking about it yet in this scenario. Also, given the nature of this video and what we're talking about, I'm not a financial advisor. This video is solely for entertainment and educational purposes only. Smash the like button, subscribe to the channel if you're new, but let's get straight into it. Now, to be totally clear, this isn't a get-rich-quick scheme. It's not foolproof, and of course, market dynamics may change and shift at any point in time, which means this may stop being effective. And that could be anything from Russia and the Ukraine conflict worsening, or even the changing of inflation guidance, so investors should be totally aware of all of these dynamics before embarking on a strategy like this. So ultimately, all this strategy is identifying the most volatile stocks and those which are likely to move by the largest magnitudes following its earnings announcements, and having a straddle position on those. A straddle is basically an option strategy which involves buying both a put and call option at the same strike price and on the same execution date. Now, as you should not be doing this if you don't know what a put and call option is, I'm not going to go into that in this video, although if you are interested to learn about those, please let me know and I can create another video specifically on those. Anyway, in this strategy, the investor should buy a put and a call at the same strike price, and this should be at the money or at the current stock price. How you make money from this strategy is by the stock price moving by a greater magnitude than your options are currently at. Now, this can best be explained by this chart. If the stock price doesn't move, the investor loses only the premium paid for that option. As the stock moves slightly, whether positively or negatively, the investor recoups some of the premium but is still at a loss. However, if the stock price, and by function of that the options price, moves by a greater magnitude than the premium that the investor's paid, then the investor will be profiting from this position. Here, what you're doing is basically betting on volatility, either positive or negative movements in the stock price following the earnings announcement. Now, the question on everybody's lips is probably, why do investors not do this at every earnings season? And the answer is actually pretty simple. In the market currently, we are in a period of heightened volatility, and one of the results of that is stocks moving by larger magnitudes than they typically would do and being more volatile. Typically, assuming a more normalised stock market environment, a stock moving by say 2 or 3% following its earnings announcement under this strategy would leave the investor at a loss. But the current dynamics are driving much larger movements, which makes this strategy fairly sensible and feasible. Now, clearly the first step is identifying the appropriate stocks to employ this strategy with. In the Discord group, and that's found through the Patreon, we've refined a framework and we've identified a number of stocks which we'll be playing this strategy on, who are announcing earnings over the coming weeks. Now, when using this framework of identifying the stocks and backtesting this, 100% of all those stocks that were identified by this framework fell within this criteria, delivered an outcome that would have put the strategy in profit. However, you want to be picking the stocks that have the greatest expectation of a greater volatility, and so you should be looking at those with a higher beta, ultimately. Now, the next step is then understanding whether, on the basis of the options prices and premiums, what movement is required within the stock price to break even. As a two-option strategy, you add up the premium on both the put and the call side of the options, and then look at this as a percentage of the stock price. Say, for example, the sum of the premiums on the options is $3 and the stock is trading at $60. Then as long as there is a stock price movement of $3 or more, either positively or negatively, so that's 5%, then the strategy will be in profit. Now, I always get asked what platforms I use, and there are a couple which I do use, and I can go into those in another video. But if you're serious about investing, especially options, then for me the best platform is Interactive Brokers. Now, I have included a link in the description below where you can get $1 of Interactive Brokers stock for every $100 you invest. There ultimately is no benefit to me under this referral link whatsoever, unless you deposit $10,000 or more and maintain that level of liquidity in the account for a year. In other words, I'm not sharing this link with you for anything other than your own benefit. It's the best platform if you're serious, and it has the most professional interface and easiest options. Now, what I particularly like about Interactive Brokers is that it does have an option strategy builder that from a drop-down menu basically enables you to build any option strategy with almost one click. Whether that's a straddle, as we're talking about here, or other strategies such as a strangle, loads of others. It's one click and it's really simple, and for me it's probably just the best platform and it's the one I typically use most often. Now in summary, this is a strategy that for experienced investors could present some great opportunities from the heightened volatility and the current earnings period. One word of caution though is that this is not a get-rich-quick scheme. Whilst on backtesting it's proven 100% effectiveness, this is no indicator of future performance. Make sure you always practice effective portfolio management with your strategies, and remember that the risk profile from options as a result of leverage and theta decay is significantly greater than that with stocks, and so they're just not suitable instruments and investment tools for all investors. Anyway, that's it for today's video. I hope you enjoyed the video. If you did, please smash the like button. If you're new to the channel, make sure you're subscribed and check out the Patreon for the private Discord group. As always, please let me know your thoughts and comments in the comment section below. I find it so interesting to hear all the different opinions and perspectives, so please get involved. Thanks again for watching, and I'll see you in another video.